Hey, welcome everybody. It's a privilege to have a LP on our podcast for the first time. Welcoming Rohan from Waterfield. Rohan heads the AIF and alternatives practice at Waterfield. Welcome, Rohan. Tell us a little bit about yourself. Right? How did you become a fund of fund manager?
First and foremost, thank you for having me on this podcast. Let me take a couple of minutes to talk about sort of this journey. So I used to be in a venture capital fund. I was with Bloom Ventures. It was one of the investment principles there was looking at investing into fintech startups, some of which continue to do well, touch wood. But I also work very closely with the partners, helping them plan and raise their own fund. So I would accompany them on some of the road shows that we would do with certain LPs, made a couple of trips with them to the US, and realized at that time, at least at that time, not just Bloom, but all Indian VC fund managers preferred raising international capital as opposed to India capital. And there were a variety of reasons for it. Indian investors at that time were not, let's say, sophisticated enough, did not understand the asset class well, were not reliable in terms of, they do a small check in fund one, but they might skip fund two, they might think about fund three, but they might come into fund four. So they were not predictable in terms of how they would behave. And of course, a lot of them didn't really understand the asset class, so they would need constant support and hand holding. International investors, the exact opposite, right? They've seen this asset class play out across multiple geographies. They cut large checks, they cut checks across multiple funds as opposed to just one fund. And so for every Indian GP, the holy grail was, okay, can we raise a lot of international capital, because then we don't have to worry about fundraising perhaps. But when we went to the US, at least again at that time, which is 2015, 16, 17, most of the time would be spent talking about India, and maybe a little bit of time would be spent talking about the fund itself.
I know. Yeah, they couldn't get past the India hurdle.
Exactly. And we're still riding on bullock carts according to them. At least again at that time, things have changed. But that was very frustrating for every GP when they were trying to raise international capital. And I realized that that's because there is no institution that GPs could go to in India who would behave the same way as those international investors. Somebody who understood the landscape, understood the asset class, can be a reliable investor across funds, can cut larger checks. And so that was the opportunity that was obvious and something that I thought would be interesting to build out. At the same time, one of the LPs in Bloom, I think they continue to be LPs, was this firm called Iconic, which what they did was they collected capital across well-known family offices in the US, and they became LPs and co-investors across funds in Asia and the US. In fact, they can cut very large checks now. And I thought maybe there's a way to build something similar in India where you can institutionalize domestic capital and build out sort of an iconic model.
Awesome.
And so that's what brought me to Waterfield. So Waterfield is a wealth advisory firm. That's how it started. I joined them, like Anand pointed out, to head the alternatives practice. And the idea was, can we groom that into a fund of funds business so that you'd suddenly have an institutional LP who you don't have to talk about India to.
No, and Rohan, I saw we met when we were thinking of a fund of fund, and it's fabulous to see. Again, congratulations again on the
Thank you.
success of raising and deploying fund one.
Thank you.
You're raising fund two now. So just for the lay audience, right? And of course, the Indian LPs our families are now way more sophisticated than in 2015, right?
Yeah.
We love the questions they ask now.
Yeah.
Much more nuanced questions now. What is the role of a fund of funds, and what value does it add as an additional layer in the whole ecosystem?
Yeah. And this is something that, of course, we had to spend a lot of time on educating our first LPs, right? Why should we do a fund of funds? They would ask. 2 layers of fees. We know a lot of the fund managers ourselves. Why go through you as opposed to go direct? The first reason rather to do this, I always explain, is that there is a big adverse selection issue in private markets in general. If you're a VC, if you are not a big brand, you will not see the best entrepreneurs come to you. And the same thing goes for LPs and GPs as well, right? GPs will go to big brand LPs, large check writers, people who've been around for a long time.
True.
And that'll be your first port of call. And if that's not possible, then you start going down and reaching out to more family offices.
True.
Then the challenge is the check size. If you are a successful fund manager, you will almost always be oversubscribed, which means you will almost always prefer
Bigger
large
checks.
checks,
Yeah.
right? And so, as a family office, if you don't have the ability to consistently cut large checks in a particular fund, you are putting yourself out of favor with that fund, and it's
Yeah.
going to be tough to participate in that journey.
And also the ability of a family office to diversify across
Exactly.
multiple funds across cycles with large checks.
Exactly.
That means
Exactly.
a lot of deployment commitment.
Tremendous conviction into the asset class, which a lot of families have not had so far. Maybe things change hopefully.
And like you said, Rohan, I mean, all of us are now trying to go away from individual checks.
Yeah.
Practically everybody wants, 10, 15 LPs with, 5, 10, 20% commitment to the fund, etc. That's all
Yeah.
everybody wants.
The dream.
That's the dream.
Construction, yeah.
Dream construction of a portfolio.
Yeah.
And in that, somehow family offices, except a few, will not be the first preference of a
Exactly.
successful VC fund. Awesome. And so you're basically saying ticket size, access,
Yeah.
expertise.
So access is an easier one. I think that's probably the most objective way to, like, okay, we have these funds in our portfolio. Do you have access to those funds? Yes, no.
Absolutely.
Right, done.
True.
But if you do, even if you do have access, the ticket size that you pointed out, very important, right? You may know the GP and the GP may want to have you as an LP, but they'll say, you know what, I've got very large LPs in my cap table. I'll take 1 crore from you. Having access for a 1 crore check in a fund where you should be writing 50 crores really doesn't make sense either.
True.
Right? So allocation and ticket size is also a big problem.
True.
And the third bit is, I think the way I like to frame it is that nobody likes fund investing, or very few people love fund investing. They love direct investing. Even family offices want to do direct investment. There are very few, idiots like us who love fund investing. But if you want to do direct investing seriously and actively, you as a family office over the past 5-7 years would have noticed that deal flow has disappeared completely.
Yeah, very little to share with families directly,
Exactly.
right? We used to do that 10 years ago.
Exactly.
But yeah, I face that complaint from my LPs a lot.
Of course.
You're not giving direct deals to us.
And
Because
entrepreneurs-
funds are bigger,
Yeah.
and entrepreneurs also don't necessarily want a
They
lot
don't
of
want that.
direct
They don't want
checks.
multiple names on their cap table necessarily either. So even if you have been a consistent LP in India across a few funds, you might just lose out on deals unless you are a large LP in multiple funds. And then how big an LP can you be if your focus is direct investment? It doesn't really solve your problem. So that's one of the things we try to do. Because we are large LPs in our funds, we can do a lot more on the co-invest side that any family office can do individually across more funds.
Yeah. No, I absolutely get it. To come to the elephant in the room, right? 2 layers of fees.
Yeah.
At least that's the impression
Yeah.
outsiders get.
Yeah.
And recently a few other fund of funds have come into the market.
Yeah.
HDFC, there was something written about in newspapers, and there was a LinkedIn tea storm in a cup that happened around double layer of fees, and people assume that VCs charge 220 and fund of funds charge 220, and there is nothing left for the poor investor. So that's the impression which is being conveyed right now.
Yeah.
Tell us, what actually the
Yeah.
cost of a fund of fund is
Yeah.
to the investor, and what do they get in return?
Yeah. No, and that's an excellent question. And of course, I can go on talking for an hour just on this topic.
I'm sure.
But we don't have that much time. So let's think about it from an LP's perspective. What is the problem that we're solving? Access, allocation, co-investments. Can you replicate that yourself in-house? Yes, no, right? A lot of times, and I've seen this especially with private market experience, for example, because I've started off in the wealth advisory system where we dealt with a lot of large family offices. They have their own in-house teams to advise them on public market investment, but they are unable to build out similar teams for private markets. Right? It's a very small talent pool who is highly ambitious and hence very, very expensive. And if private markets are not a bulk of your allocation, it's always going to be an issue to build that in-house. So is it worth outsourcing? And is that the cost that you look at as the additional layer of fees? It's what I would have had to pay at least, if not more, to build the same expertise within my own family office. That's an easier way to look at it, right? More importantly, because of the co-invest aspect, the weighted average fee ends up coming lower because what we negotiate and what I'm sure every fund of fund will negotiate with the underlying GPs is fee-free, carry-free co-investments. So if a portion of your FOF goes into co-investments, on that portion of your capital, you're actually paying lower fees than what you would have otherwise.
To the GP himself.
Exactly. So the weighted average impact of the fees is lower than what it looks like at the headline level, right? The third point I like to make with everybody is that if by virtue of the expertise and the knowledge of the market, a fund of funds can help you avoid a single bad investment, you more than made up for that additional layer of fees. Investing 3 crores in a fund that goes to zero versus paying 30 lakhs extra for a fund that will actually return some capital to you, if not do well, may be a
Just to sort of quantify the impact, Rohan. So for the eventual investor, does this become like from a 220? Does it go to 330? Does it go to 440? It looks like 440, but actually, what is the impact? To give you a broad range.
Yeah. No, so in fact, if I look at our fund one, and we did some, I'd like to think, clever engineering on fees, the eventual impact was a 0.2 to 0.3% additional leakage on the management fee side. And on the carry side, actually, it was lower than 20%.
Oh,
Because at least again, concessions made
Because
to
of
fund one,
direct
because
investments.
the directs versus exact, fund versus direct. That bring it
So
down.
broadly, steady state, you're saying that the cost will be something like 2.5% instead of 2 on fee side,
Exactly.
and maybe on carry maybe 25% instead of 20. Am I right? Will that be
No,
like
absolutely. That's how, and there are many levers to do it, of course. So, a lot of fund of funds, what they do is when they raise a new fund, they give some sort of a fee holiday to their LPs from the previous fund.
True.
If they come back into their new fund, right? Which
Right.
of course we will do. So,
Yeah.
while you entered into fund one with a certain expectation of fees, it turns out that you'll end up paying a lot less if you continue to participate in the franchise. So that helps. The second bit is what everybody seems to be doing in India, which is a great move. Most funds themselves are also very cognizant of the fact that they can't just take away 20% of their committed capital and use it for fees. You guys do it really well, and a lot of other GPs have started to realize that as well. That I can't only invest 80% of the capital I raise and expect to outperform and deliver healthy IRRs. So the best way to do that is just by investing more of that capital, which means even at your level, if you think about it, we are not paying
True.
that fee.
I
So
agree.
when it filters up to our LPs, they're actually not losing 2% per underlying GP either.
No, and I think another aspect I wanted to add, Rohan, here from my perspective is that getting a fund of fund check doesn't involve distribution costs, right?
Yeah.
Which from my perspective I'm saving,
Yeah.
right? And it has to be then weighed against that.
Yeah.
So I'd rather take money from you than to distribute through an intermediary to individual investors, and that is a saving in the system, which of course will directly indirectly be accrued to the fund of fund LPs, right?
That's a very good point. I think LPs don't realize that eventually they're the ones paying the distribution cost.
Exactly.
Right?
Exactly.
That's what it is.
Yeah.
You can disguise it any which way. You can call it a setup cost. You can call it a flat 2% management fee for 10 years.
Yeah.
The LPs are losing out.
Yeah, I think it's a no-brainer per se from where I see, because for us, of course, a good check, good quality of governance, bulk of fund of funds like yours will be on the LP advisory committee.
Yeah.
I can see why this should make sense, right? But then, of course, costs of investing has been a bone of contention across
Yeah.
the board. I think we enjoy discussing a lot about it.
Yeah, no, and I don't know if this is a cultural thing, but it is definitely a cultural. You would have seen that with your companies pitching to Indian SMEs and Indian corporates as well, right? It's all about, can we reduce the cost?
It's changing again, and I can tell you, like, as sophistication increases,
Yes.
People can distinguish the real impact, right? I
Yeah.
think it was probably in the early years, and of course, you raised the fund from Indian family offices. So
Exactly.
that's the testament to it, right?
No, absolutely. I think we were pleasantly surprised by how family offices responded to it. And I think we're happy to have a very solid portfolio as well, and GPs who vouch for us. So that's really helped. But it was a refreshing experience. Fundraising is never easy, but at least families who had not done any private investing, they saw a lot of value in what we were doing. The families who had had a bad experience with private market investing did not want to touch us because they felt that they knew the market and the market was not good and it doesn't make sense to invest.
So, very true, Roman. I think, as people become more sophisticated, I think the market will go into two ends in investing into VC funds. One, the most sophisticated people who want to deploy large amounts of money will go to fund of funds. And the investors who want to get a personal thrill of picking, they'll probably go to the syndicate market. Of course, not the smartest thing to do. Looks cheap, but actually the incentives are completely misaligned there. But I think the market will split into two ends, right?
Yes.
And I think by and large, the top performing funds will stop direct investments from retail investors or individual family offices, right? So of course, it's slightly more expensive, right? But not as expensive as what it's made out to be. Optically, what people think from outside. How does this perform globally? How have these VCs performed in spite of and have all these things like access, ticket size, governance? Has this panned out well globally?
Yeah. No, and that's again, it's a very good question. Of course, I don't have all the data, but I have anecdotal data across a few of the fund of funds we follow and we track and we look up to. So there's two types, right? If you look at the US, the funds of funds are almost entirely driven on access. We have they'll have 60% of their capital will go into Sequoia, 20% will go into Benchmark and Recent, and they're done. They're like, okay, this is what we do. You can't do it yourself. We do it. And they have obviously consistently been in the top quartile as a fund of funds, right? Even if you match them with their underlying funds, they've been in that top quartile. The Silicon Valley Bank has a good fund.
So the fund of fund performance is matching top quartile VC funds.
Exactly. Wow. Because they're only, the leakage is only in terms of management fees, which they keep very low because they're not doing anything but accessing these funds. They're not on the LPACs, they're not a big LP in a lot of these guys as well. So for them, it's just access. So the fees are, 40, 50 basis points, that's it. Carry is 4-5%, that's it. So if your underlying funds do well, you're going to do well. And top quartile funds outperform the median quartile by like 10, 15 percentage points in terms of IRR. Shave off 2%, 3% from that, you're still in the top quartile. Right? So that works. In Asia, you have fund of funds which actually are experts in the geography, demystify the landscape, and then they juice the returns through a co-invest sleeve, right? So they are not just access funds; they're actually active management, seat on the LPAC, proper allocations, a thoughtfully constructed portfolio, and then because by virtue of all of this, we do co-investments as well. So their fees are higher, right? They charge 1%. Their carry will be a bit higher, but their performance also ranks somewhere in the top, right? One or two co-investments really move the needle. If you pick the right fund, then they end up being top quartile. They're also fairly high. So the risk is compensated, the cost is compensated very well by the portfolio that these fund of funds build out. So they will also end up being, if not in the top quartile, close to top quartile. Somewhere in that 18 to 20% net dollar IRR numbers. Right? So this may be the most boring way to make money in some sense. That's how I think about it. So
and I think that which is why I'm saying the only reason not to do a fund of fund is that it's boring.
That's it.
It's a good enough reason, of course.
You have
No?
to just get over that hurdle mentally that you are not going to be actively involved in picking founders and investing, finding a diamond in the rough. If this is going to be a part of your portfolio just to make money, it's a no-brainer.
Understood. Okay. Now the question that I'm sure all my peers are looking forward to. I'm also I get confused why we got picked up by you guys. So how do you pick a fund, right? Let's say
Yeah.
a venture capital fund,
Yeah.
and what would be like your ideal VC construct when you'd like to invest?
So a lot of times it goes top down, right? So let's start with what is the strategy of the fund of funds itself. So when we started Fund One and as we get into Fund Two, we've always been fans of having a very concentrated portfolio of GPs across strategies. So we're not a seed fund only FOF. We're not a growth fund only FOF. We want to do people across the spectrum, but one in every segment, if you will. So one seed fund, one Series A fund, one growth, one private equity, one sector focus fund. That's what we did in Fund One. We'll extend that a little bit in Fund Two. So automatically you're restricting your universe to a certain set of strategies and you're forcing yourself to pick the best one. How do you pick the best one? Because this is so concentrated, because this was the first time we did it, we weren't going out on a limb to take on unnecessary risk. We wanted to bet on folks who have been in the market for a while, teams which have been together for a while, right? Where we have a track record that we can actually verify.
Okay.
So that again filters out quite a few funds. So we didn't do any first-time fund managers.
So fund 2, 3, or 4.
2, 3, 4, right? That will change with Fund 2 for us, of course, but not by much. Maybe we'll do one first-time fund manager, right? Now, once you have the final little universe of funds that you can look at, what matters, right? For us, the most important thing is the team. Think about each fund as being like a marriage you can't get out of in some sense, right? It's 2 GPs, 3 GPs, 4 GPs for 10 years per fund. If there's any issues, it's going to get ugly. So we want to back teams which we think can stay together for the long term and have worked with each other for a long time already as a data point to show that they can, if they've done it for 10, they can do it for 10 more. Again, that filters out quite a few funds. The track record becomes crucial when you're looking at funds which have seen cycles. And in India, interestingly, we've not had such a long journey that there's data around fund performance out in the public market. There's very few funds which have actually closed and returned their money to their LPs. So you can't really just look at those numbers and say and extrapolate it and say, okay, this works. But what we try to do is look at the discipline of these fund managers across their multiple funds. Have you suddenly been investing too much and suddenly went cold and stopped investing at all? We look at decision making across these cycles as well, right? How did you handle 2015, 16, 2018, 19, now 2021, 2021, 22? Did you invest at the peak of the market? Did you slow down or stay away from the peak? Did you go aggressive when the market was slow? These are all indicators to us to show that, okay, if a cycle comes up in the next 2, 3 years, these guys will be able to.
Yeah, I see that cycle there, right? I mean, a lot of your funds were quiet in 21.
Yeah, yeah. And they were very active in 2022, which is a great time. Now, it may or may not work out, but at least it seems like the right time to be active, right? And then I think for us, what differentiates us and hopefully where we add value is that we've been tracking this market for the past 7, 8 years now, and we've seen a few cycles ourselves. Me and my managing partner Siddharth Junjunwala. So in some sense, you can't bullshit us, right? In some sense, we know what GPs were doing in 14, 15, what they claimed they will do in 17, 18, 19, what they actually did in 17, 18, right? And there are folks who have been very consistent about what they said they will do and kept doing it. Very transparent and open about, okay, these things did not work, so we changed. and now we do this. And that's not something anybody can just walk into. Right? If somebody just today decided, hey, I want to become a fund of funds manager, how will you educate yourself on people's behaviors or GP's behaviors over the past decade? It's something you see and observe and know. And because we chose a very conservative fund of funds portfolio construction, it was easier for us to pick the managers because we just we just knew how each of these individuals has been thinking and will hopefully think in the future.
Awesome. Rohan, just one last question. How much do you guys contribute in the governance of the fund? I mean, is it really a very active role, or
No, that's a good question. I think I think people don't realize what it entails, right? What is an active LP position? What does that even mean? For most family offices, you put in the check and you don't hear back from that fund manager
Yeah.
till they're raising the next fund, right? For us, that shouldn't be the case. That is not the case. What we've chosen, at least per our strategy, and different funds of funds may have different strategies, but we want to be active in this. So what does that mean? We're on the LP advisory committee right now. An LP advisory committee is just a way. What I would call it is the equivalent of a board
Yeah.
for the fund managers, right? It matters a lot when things are going south. Maybe it doesn't matter as much when things are looking great, right? Now, tomorrow, if there's a split in the GP team and one of the GPs backs out, it's the role and responsibility of the LP advisor committee to ensure that all LPs are taken care of, that due process is followed, that we make sure that unnecessary and random decisions are not made in this acrimonious time, that everybody takes a breath, steps away, and resolves the issue in the best way possible. So that's very important. But other than that, other than just the formal responsibility of sitting on the LPAC, what we've at least realized is that a lot of Indian GPs do need some help in positioning themselves with international LPs. Right? They've not had too much experience working with international LPs. We help with that a lot. We know a lot more of the international LP community. We kind of understand how they think to a certain extent, and we're always a good sounding board if required for that GP to figure out, hey, how do I deal with this LP or these constraints or these requirements? That's why we try to come in. And lastly, I'd say just on that sounding board logic, a lot of VCs, for example, you want to be a resource for your founders to reach out and be transparent and open to you and see if you can genuinely help them. And it's easy for founders and early stage VCs such as yourself, Anand, you're getting calls from all your founders all the time, I'm sure. Can we be something similar for our GPs, right? Who watches the watchman? Like, who GP is the GP?
Yeah, I mean, I think I agree. I think just simply having somebody come over every few months and asking all the right questions, nudging you in the right place. For example, how often do you raise a fund?
Yeah.
These kind of things, you will sort of, be an input in the decision that we make. So,
and hopefully it's helpful, but sometimes if it has to be against the wishes of the GP, then it has to be against the wishes of the GP. Everybody needs at least that input.
Of course, yeah. We at least we know that this is sort of not something that some of our key investors are advising for.
Yeah.
So we know, and we might do that. We may not. We need you to invest in our fund. So we might simply say, okay, Rohan is saying something. Let's listen to him. So it might work both ways.
Might work.
It's been a pleasure, Rohan. Thank you so much.
No, thank you for having me.
Okay. Bye bye.